There's a new way for you to get equity out of your home and use it for whatever you want. This is radically different than anything that you've seen before because there's no monthly payment and there's no interest charges. There's no income requirements, and qualifying is fast and easy. Woo-hoo! It works for people with poor credit, and it works for people who've already been declined or denied for a conventional home equity loan or a home equity line of credit. So, how much of your home equity could you use right now?
So in this video, you'll discover a revolutionary financial innovation that gives millions of homeowners access to anywhere between $15,000 to $500,000 or more of the equity tied up in your home without making any payment on it for up to 30 years. Wow.
It's amazing.
Yeah. So huddle up, team. We hope you are all doing great. If you are new here, we are John and Tara Thorman, your financial success coaches, and we're here to help you achieve financial freedom faster so you can enjoy it longer.
In this video, we're talking about financial innovation, known as the Home Equity Agreement, or some call it the Home Equity Sharing Agreement. Some people call it Home Equity Investment. Now, we just heard about this for the first time like a week or 10 days ago, and we were blown away. And it's like, I got to share this with you right away. So we're going to train you on this new innovation, okay, and teach you this home equity tool to find out if this is something that needs to go into your playbook or not. You're going to get actionable training so you know how this equity tool will work, who it's best suited for, the pros and cons, and who should stay far away from. You can check out the timestamps in the description box below so that you can go right to the points that are most important for you. But check this out. Are you ready?
Okay, we're going to tackle the topic right now after you
crush that like button
and subscribe to our channel and select that notification button so you can attend every practice with us going forward. So what exactly is the Home Equity Agreement?
The Home Equity Agreement is relatively new and it's gaining in popularity. It's not a debt in the traditional sense like you would expect. It's not like a home equity loan or a home equity line of credit, but it does give you access to the equity in your home. This thing is completely different. It's based in part on the equity you already have in your home, and we'll show you the numbers in just a few minutes so you can look at the alternatives and see if it's right for you. Now, a home equity agreement allows you to partner with an investment company and share your future home equity with them. It works like this. The investment company pays you a lump sum of money right now, and you give them in exchange a portion of your future equity. Think of it kind of like your home is a business, and the business is selling shares in order to raise capital. It's kind of the same way.
Okay.
Now, you might ask yourself, well, what the heck does an investor want with part of my equity? Well, they expect your home to appreciate in value over time, and it gives them an opportunity to earn a good rate of return in a completely different asset class that's not correlated to the volatility of the stock market. When you sell your home in the future, that's when the investor is going to recover their money. They're going to get paid back the money they advanced you, plus they're going to get paid a percentage of the equity growth that has gone on over the years. So, you might be asking, well, how much equity is there in people's homes? A lot. According to an August 2024 report by data firm ICE Mortgage, the amount of equity that those homeowners could tap into or could access is $11.5 trillion. Wow. $11.5 trillion in accessible equity is what is going on in our country right now. So, how much accessible equity do you have tied up in your home? Have you got $100,000, $500,000? Maybe you have $1 million or more in untapped equity that you could get to and don't even know it. So, how does a home equity agreement work? Well, the amount of money you can get from the investment company will vary depending on several factors. And each of them have their own guidelines and rules and regulations, okay? It's kind of the Wild West in terms of this new asset class. So it's all over the board. So if you want to look at it, you're going to have to talk to a bunch of different companies and compare their offer to make sure you're getting the best thing for you. But what they look at are your credit score requirements, there's maximum loan amounts, there's repayment terms, that change. There's risk adjustment percentages, which is a big deal, and we'll get into that in a minute. Of course, there's fees, and it all depends on where you live because it's not available in every state. And all these different companies that are competing don't have the same footprint. They're not all competing in the same states. So it's, like I said, it's kind of all over the place. The risk adjustment percentage, though, has a huge impact on how much your home equity agreement is ultimately going to cost you.
Okay.
Basically, the risk adjustment protects the investment company in the short term from a dramatic decline in the home values. For example, if your home appraises for $500,000 and the investment company uses a 25% risk adjustment on your particular home, then the starting value that they will use to calculate the equity sharing won't be the $500,000. It'll be 25% less. It'll be $375,000. So in the future, it could be 10 years or 20 years or even 30 years down the road, they'll look at how much has the equity appreciated in the value of the home starting at 375, not 500. That's the risk adjustment feature, okay? The risk adjustment numbers are going to be all over the board, and it depends on where you live, the expected price appreciation on the home, and all these other factors. But the range is wide. I've seen from 2.75% all the way up to 30%. So you have to compare and get multiple offers. Now, where the investment company has the short-term downside protection, some of them will offer you, as the owner, some upside protection as well, a cap on how much of the growth in the value of your home you have to actually share with them, right? So if your home value just goes up dramatically, there can be a maximum cap that you have to share with them, and they don't take all of it. Again, not all these companies offer it. You're going to have to look at the offers and compare them. Now, most companies require a minimum credit score of at least 500, which is way lower than if you want to go to a bank and try to get a traditional loan, right? So this is where people can really find help that they can't normally get. But other people, they want a little bit higher score, maybe 600 or a little bit more. It just depends. The max loan to value, or LTV ratio, for this shared equity agreement is typically between 70 and 85%. That means you will need to have between 15 to 30% equity in the home already. But for most people that bought a home 3, 4, 5 years ago, man, you could have double it what you started out with. So where on earth can you go get one of these home equity agreements, right? Not from the bank or credit union or mortgage broker. None of those traditional, home equity loan type situations. They don't do this.
Okay.
This is specialized, and it's specific investment companies that offer these kind of arrangements. So you got to look out for them. So here's a quick table. I've listed there's 2, 4, 6, 7 different companies that you could check out. I guess first you need to make sure that they offer this in the state that you live, but then you got different terms and agreements here. And then you can see some people only offer terms up to 10 years, some are 15, but there's several that will let you carry this out for a 30-year time frame. The other big difference, though, between all of these companies is going to be the percentage of your future equity that you have to give away in order for the cash right now. You've got to compare that because that is all over the board as well. You could have 20% equity that you have to share with them, up to 49% maybe. You have to maintain the majority ownership because these are all going to be like minority partners basically, right? But that percentage is going to be all over the board, and you're going to have to compare it to see what you can negotiate. So what does a home equity agreement actually cost? So you can go and apply at these places for free and start being able to compare offers and terms, right? But the actual amount of money you receive up front is going to be reduced before it hits your checking account by the closing costs. There's some fees that have to be paid that will actually reduce the amount of money you get. So there's origination fee, and that can range between 3 to 5%. There's an appraisal that could be anywhere from $200 to $1,250. Home inspection, title services, escrow services. So if you add it all up, there could be thousands of dollars. It just depends on how much money you're getting, okay? But if you had $50,000 that you wanted to sell, or $50,000 you wanted to receive and sell a percentage of your equity, then it's reasonable that when that deal's done and they make the deposit in your account, you're not going to get 50. You might get 44,000 or 45,000, something like that. There's going to be some closing costs.
Okay.
Now, what happens when the term is up with your home equity agreement? Well, you got to settle. What are the terms, right? If it's 10 years or 30 years, you got to settle. And what you have to do is pay back the original amount they advanced you,
Okay.
right? Plus, then you've got to pay the share of equity that you owe them.
Mm-hmm.
That's how it works. So the way that you are going to handle that is you've got to plan ahead. You got to be prepared. So if it's in 20 years, let's say, and you borrowed 50,000, you're going to have to pay the 50, and then you're going to have to pay them the percentage of the equity share. But you got to be prepared, because if you can't give them the cash, if you haven't saved up in advance, then you will have to maybe do a complete cash out refinance, which you're going to have to qualify for traditionally, right? Or you sell the home and you pay everybody off, and then you take what's left over and you go on your merry way and find somewhere else to live. Now, let's take a quick look, an example here of how much this equity sharing could cost you at the end of the term. Suppose your home is appraised at $500,000 today, and the company chooses, as your co-investor, to make a risk adjustment of 10%. So the equity share is not going to start at $500,000, it's going to start at $450,000. Then, if you decide to sell 10% of your future equity in exchange for a $50,000 payment now, the math would work out like this. The original adjusted home value is now the lower amount at $450,000. The future home value in whatever time that is, 20 years let's say, is $600,000. So that total equity appreciation is the difference, is $150,000. So you owe the original $50,000 they paid you up front, plus you owe 10% of the $150,000 gain, which is $15,000. So in total, you would have to pay $65,000 to settle with the investment company at the end of the term. Okay? Who is right for this? Who is the ideal candidate to take advantage of a home equity agreement? Well, if your financial situation is not strong, and especially if you need money, then this could be a great solution for you. I think there's 3 and maybe 4 use cases for the home equity agreement, depending on the terms you can negotiate. So let's take a look. I think, first of all, if you are home equity rich, but you are cash poor and you need money, then this could be a really great option, because you get a lump sum of money and there's no monthly payments. Next, if you have low credit scores, you've got some debt challenges, maybe high debt to income ratios, which the banks are not favorable with, right? Then you're probably going to get declined. So the HELOC, or the home equity loan, is not going to fly. That makes this a great candidate for you. Next, if you have high interest rate debt, like credit cards that are 25 or 35%, and you can't get approved for consolidation loans or anything, then this would be a great candidate to leverage the equity in your home and fix some of that mess. Finally, if you have the majority of your wealth tied up in your home and you want to diversify your wealth into some other asset classes besides your home, then this could be a good opportunity for you, especially if you've got some cash flow issues. Okay, diversify your assets into some other, maybe more aggressive growth opportunities, or even something that provides more income. This could really work for you. So who is the home equity agreement not for? Like, who should run from this idea? Okay, if you're financially fit, if you have good cash flow, and you've got the additional money to make payments on a loan, on a second mortgage, on a home equity line of credit. If you're strong and you've got the cash flow to make those payments, this is not for you. Okay? It's not for you. And here's why. It's about the cost of capital. You're going to pay a lot more money in those capital costs, a lot more money than you would with a traditional loan and paying interest. So for the financially fit, your lowest cost of capital is going to be a traditional loan. Let me review these pros and cons for you really quick, okay? The pros of a home equity agreement are there's no monthly payments to make. You aren't taking on more debt. Generally, there are no income or employment requirements, so super easy to qualify. You can exit the agreement at any time without penalties, and you can qualify with a terrible credit score as low as 500. Now, the cons of this home equity agreement is that it can cost considerably more than a traditional loan option, especially if your home appreciates dramatically over time. Number two, there's no standardized contracts between investment companies. The terms are complex and they vary a lot between every investor. So you got to spend some work in deciphering the agreements and figuring out and understanding what your costs really are and what your potential risks are. Number three, it's not available in every state. Each company has got a different footprint. Each company works in different states. So you might want to check that out first. Then you will need to make a large payment at the end of the agreement period. You got to be prepared for this, okay? Otherwise, you could be forced to sell your home when you're not ready, okay? Number five, possible impacts on your estate plan and your heirs inheriting your home. Again, you need to look at the legal ramifications and plan ahead for that. So, in conclusion, I am pumped about this because I really love the financial innovation.
Right.
I think that's so exciting, but this product is not for everyone. You want to minimize the risk adjustment factor, and you want to minimize the percentage of equity that you have to give up in exchange for the money. So to help you with that, get multiple offers and negotiate, okay? And get the best deal for you. Hope you love this and share this with other people. More people need to hear about it. It's a great option for the right person. See you on the next video.